budget, and the run into the festive season has now begun in earnest with the Black Friday and Cyber Monday weekend. But there's plenty for investors to ponder in the first week of December. A busy slate of corporate results here includes the following companies, pending, of course, any late changes. And they're Peel Hunt on Monday, the 1st of December, Victrex On the Beach, Tops Tiles and IG Design on the 2nd, Moni Group and Victorian Plumbing on the 3rd, and Balfour Beatty, SSP, Baltic Classifieds and Watches of Switzerland on the 4th. However, we're going to focus on 3 other firms, and they all face the consumer, directly or indirectly here in the UK. They're commercial property landlord NewRiver Retail, specialist lender Paragon Banking and retailer Frasers. Each update seems timely, given the latest drop in consumer confidence as measured by the monthly survey from consultants GfK. NewRiver's first half results are due on Tuesday, the 2nd of December. After last year's cash and stock acquisition of Capital and Regional for £151 million, the Real Estate Investment Trust, or REIT, runs a portfolio of 23 core shopping centres and 13 retail parks with a gross value of nearly £900 million. Key tenants include Boots, TK Maxx, B&M European Value Retail, Poundland and Superdrug, not to forget Sainsbury Next and Marks & Spencer. For all of that, NewRiver's shares have struggled for a while due to worries over the UK's economic outlook and the relentless assault on brick-and-mortar retailers from online rivals. So this is a chance for Chief Executive Alan Lockhart to restate the case for the REIT's business model, and the Capital and Regional deal for that matter, with all of the associated implications for where the share price stands relative to net asset value. As with all REITs, analysts will assess the trends in occupancy rates, new leasing activity, rental income, and also debt maturity and lease length. In the case of NewRiver REIT, they'll also look for a progress report on the integration of Capital and Regional, as all of these trends will shape the 2 key headline numbers. The first is net asset value, or NAV per share, which was 102 pence at the time of the full year results to March. The shares trade at a 34% discount to that as I sit here. And the second number is the dividend per share. Analysts are forecasting a 6% increase in the full year payment for the new year to March, so that seems like a fair benchmark for these first half results. NewRiver, by the way, made an interim payment of 3 pence a share last year. Shares in Paragon Banking, well, they've ebbed a little bit of late as well, and they've therefore just failed to recapture the levels reached in 2005-06 ahead of the great financial crisis. Again, concerns over the UK economic outlook are an issue here, alongside the tepid housing market, and Chief Executive Nigel Terrington did steer guidance for new mortgage lending to the low end of the guided range when he gave July's trading update. When it comes to these results for the full year to September, due on the 3rd of December, analysts will focus on 5 key guidance points already offered by Mr. Terrington, namely £1.6 billion in new mortgage lending, £1.2 to £1.4 billion of commercial new lending, a net interest margin above 3%, operating expenses below £185 million, and a return on tangible equity of between 15 and 20%. Any steer for the year to September 2027 will also be of interest, as that will help to shape forecasts for profits and dividends. And also, please do keep bear in mind the figures and forecasts for loan impairments, which remain modest for now, as will any further charges relating to the car financing market after the modest £6.5 million provision swallowed in the first half. Now, in terms of the headline numbers, the analyst consensus forecast for Paragon Banking are pre-tax profits of £275 million, up from £254 million last year, with a modest improvement to £280 million seen coming up in the new financial year, and a dividend of 43.1 pence a share, up from 40.4p a year ago. Note that Paragon continues to run a £100 million share buyback programme, while analysts will also look at the tangible net asset value per share figure as a valuation benchmark. This was 611p at the last count. And finally, we come to Frasers, the parent company of Sports Direct, House of Fraser and Flannels, to name but 3, where Mike Ashley is still the majority shareholder. The shares aren't that far away from 2022's all-time high, but again, a soggy UK economy and an extra £50 million in costs thanks to changes in national insurance contributions and minimum wages in last year's budget have combined to dampen sentiment a bit. To mitigate the impact of these issues, Frasers has an elevation strategy, whereby it's branching out into more premium brands and chains. It's also got a drive to expand overseas, and also an efficiency program, plus it has launched the Frasers Plus Buy Now, Pay Later service. The first half results for the 6 months to October are due on Thursday the 4th, and ultimately, analysts will then see if Chief Executive Michael Murray sticks to his forecast for the full year to March of adjusted pre-tax profit of between £550 and £600 million, and that compares to £560 million a year ago. The benchmark for the first half results is the adjusted pre-tax profit figure of a year ago of £299 million, when the stated pre-tax income number was £207 million. Note that Frasers has never paid a dividend, although it has run share buybacks in the past, and it's generally preferred instead to invest in its business or acquire. On that note, watch out for any update on its near 30% stake in rival Boohoo. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.